Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Uranium Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Uranium Energy Corp is a uranium mining and exploration company. The company controls a pipeline of uranium projects in Arizona, New Mexico, and Paraguay. It also has a uranium vanadium project in Colorado and also ferro-titanium deposits in Paraguay. This company has not had any revenue since 2015. The new stimulus bill provides companies like this $75 million for uranium reserve. The uranium reserve was introduced in 2020 by the Department of Energy in order to restore America's competitive nuclear advantage. The company also issues new shares to raise cash to pay expenses, which includes paying management salaries and bonuses. Let's get started with the model. This is a small cap company, 486 million market cap. They're trading at $244 a share, and they have 199 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have negative net income every year. The company has not generated any revenue since 2015. This is the company's income statement. The top line is the revenue, the sales, that's zero. Below that is the cost of revenue. Revenue minus cost of revenue gives you your gross profit. Of course, that's negative every year. Below that is operating expenses. Examples are insurance and depreciation. Below that is operating income, which is negative every year. Then below that is the interest they pay in their debt. Below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Then the bottom line of the income statement is their net income. And they have negative net income every year since they have no revenue coming in. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they, of course, have negative free cash flow every year. They're able to fund their business from the $75 million reserve they receive from the government. Also, they issue capital stock. When a company issues capital stock, that increases the shares outstanding, making your shares less valuable. They issued 600,000 in 2018 and 24 million in 2019. They also issued $300,000 of debt in 2020. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow at some point, you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And to calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. They had $320,000 depreciation. That's a non-cash item that brings down their net income. $3.2 million in stock-based compensation, $1.4 million in other non-cash items, and $900,000 in changes in working capital. Even though the company reported a $16 million loss, they actually lost $13 million of cash flow. Let's look at their capital structure. $75 million of equity, $21 million of debt. They're 78% equity, 22% debt. Their net debt is $4 million. Net debt is debt minus cash on the balance sheet. Their WACC is 19%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for. That's $855 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $496 million. We divide that by 199 million shares. And we get a calculated stock price of $249. They're trading at $244, so they're trading at a 2% discount. It's a really small buy according to the model. Simply Wall Street is much higher than me. They're at $449 a share, so they're saying the stock is really undervalued. It's hard to value a stock with no revenue and negative free cash flow. I had to use the company's estimates and analyst estimates to try to come up with future free cash flows. So I think my estimation was pretty conservative. It's interesting that I came up with a valuation pretty close to where they're trading at. This is a stock price the last 5 years. So you can see it's been up and down, but pretty steady for a few years. Just about a month ago, the stock price was under $1. Now it's up to $2.36. So you could have more than doubled your money if you got it down here. They have a really high beta, 2.24, so the stock moves more than 2 times the market. The stock has gone up 234% in the past 52 weeks, while the S&P 500 went up 17% in the same time frame. The 52-week low was 35 cents, the high was $2.56. And the stock is trading well above its 50-day and 200-day moving average. About 4 to 8 million shares are traded each day on this stock. And of the 199 million shares outstanding, 194 million are on float, 27% are held by institutions, and about 8.5% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you'd be down to $4,300 today. That's a pretty bad return on investment. That's an 8% annual loss. The biggest shareholder is BlackRock at 6.7%, then Vanguard, then Murray Asset Global Investments, State Street, and Geode. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Unfortunately, they have no sales, so we can't look at the price to sales ratio either. Price to book is stock price over book value per share. They're at 6.5, so they have a decent price to book ratio. Interest coverage ratio is EBIT over interest expense. They cannot cover their interest expense with their operating income. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities almost 5 times. And their current assets are $17 million of cash and $211,000 of inventory. The company seems to have just enough capital to get through the next 12 months, assuming it has a similar amount of free cash flow next year, because they had negative $14 million of free cash flow and they have $14 million of working capital. So to summarize, I have them trading at a 2% discount, but this is a really risky stock. I don't think you could make money holding it long term. In the short term, you could make a quick profit. But of course, anything can happen in the future. It's really hard to predict how the company will develop with its uranium production and its importance of uranium relative to the entire market. I rank their free cash flow as 1 out of 10. I rank their revenue 1 out of 10. And I rank their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.